From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Good afternoon and welcome to the COB, all the stuff you need to know about the day in business and markets and everything else. I'm Kyle Rodder with Danny Akuyo. Danny, well, it seems to have been a little bit of a sluggish session to say the least. Down, it would seem by about 0.5%, 0.4%.
Yeah, it looks like it recovered a little bit into the close, so down about 0.4%. I'm gleaning at the moment. Yeah, so a little bit of a recovery, but really sort of, you know, on a... doesn't really know where to go at the moment, does it?
Yeah, we were saying last week that we're sort of clashing for a direction. At the moment, the direction seems slightly to the downside, but still nothing really clear-cut just yet. But perhaps we'll get to the three themes of the day because that'll help us pick things apart a little bit. And to be fair, we were set up for failure from Wall Street last night, I suppose you could say. 10 out of 11 sectors were down on Wall Street. IT stocks the only higher. And again, if we can get that graphic up, if we have that available just for the three themes of the day, there we are. Stocks fade, US tech revival, because it seems to be, if there's one story we can glean from this week, a positive story from the week, is that, well, Meta Platforms has added to the number of mega cap tech names that have beat expectations. Absolutely.
So these companies have been really, really good in terms of managing expectations. They have very much streamlined their operations. There's been a lot of cost cutting going on. A lot of people have been let go of. They're moving into the AI space. Interestingly enough, ad spend for Facebook continued to hold up. So I think really the market's gone, whoa, it wasn't as bad as what we're expecting. And the companies are doing the right thing. The real question, I think, is the growth going into 2024. And the market probably in the next quarter will start to go, well, that's great. 2022 was a write-off. 2023, these companies were really smart at the front end of the curve in terms of making all the hard decisions. You know, they realized some of the revenues for certain divisions were going to come down. You know, they've got themselves in good shape. But they are going to have to now look towards generating revenue growth and bottom line growth into 2024. And I guess that's a bit of an unknown if the US goes into a recession in the third quarter, which obviously some economists are talking about.
Yeah, increasingly that's our words coming up once again. Just on Facebook, have you ever had an interest in the company in terms of, you know, owning it or...
Me personally?
Well, yeah, because I know you follow Tesla quite closely, for example. Is Facebook one that you've ever really dug deep into? Because I just can't understand why people still invest in it, to be honest, because I don't use Facebook anymore. Who's advertising things on Facebook?
Small businesses.
Sure.
Yeah, and I think eBay had good results as well. I haven't done a deep dive into it, but I think it's still very much used as a platform, this Facebook Marketplace, which a lot of people use.
I do use that.
Reels, apparently, the advertising spend is not good there, but they're hoping to transition because a lot of people are now using Reels rather than TikTok.
Right.
And they're hoping to increase the advertising spend on that going forward. But what's interesting is that whole Meta universe, that whole laboratory as they call it, so that's losing about $4 billion US a year at the moment and expected to increase. And they're not really talking about that. It's like, well, we'll just sweep that under the carpet.
Yeah. Well, they've cut back some of the investment in R&D in that, haven't they?
Yeah, but it's still, I believe, they're still, you know, the losses are expected to increase. And it just shows you the magnitude of these giants that you go, 4 billion, you know, which Google has done regularly.
Yeah.
But yeah, I think that at the moment they're riding high on the efficiencies, the cost cutting, and that whole AI theme, which has really underpinned the likes of Nvidia and Microsoft. And you mentioned Tesla briefly because Enphase in the US, my gosh, that was a train wreck. It's a solar company. And the only thing I wanted to say was the sensitivity of some of these renewables companies to a rising interest rate environment in terms of affordability for people to put solar panels on their roofs, even with all the subsidies. It's clearly those companies are being hit, and Tesla's got the same problem. It is a true consumer discretionary stock, and that's why Tesla always talks about affordability, and their cars are not affordable with rising interest rates, rising leasing costs, and that's why you've seen them cutting prices.
Yeah, and just quietly over the last few days too, I've seen Tesla shares actually move quite considerably lower.
Yeah.
Nothing too volatile, but it's just been
slow. 25% they're off.
Yeah.
So I think that's clearly like what end phase, what they had. This is kind of a flow on. It's saying that like there's a secular trend, but we've got this slight hiccup. Yeah. It's expensive. And people are struggling still with food and all those other things. Yeah.
Another thing we wanted to talk about today, obviously dug deeply into that one, but the M&A madness, as I've referred to it, because everyone loves alliteration, and well, I'm a basketball fan, so any basketball fans would maybe know the allusion there too. But just some more M&A activity, and an offer lobbed at Blackmores by Kirin. I don't know if you take your vitamins with a beer, but perhaps that's what we'll be expecting in the future, a nice Japanese lager with your vitamin C on the side. But we were just saying that that's a general theme at the moment too, which is a lot of M&A, a lot of, perhaps, would you even call it consolidation?
I don't know if Kirin getting into this. I'm not across Kirin, but I just think it's really interesting that clearly companies with cash are looking to make the most of compressed valuations of companies. And, you'll probably see more in the resources space and any of those companies that, don't have any love. I mean, obviously the InvoCare takeover was pulled, but that's what happens in this type of environment when share prices get sold off and companies say, well, we want to expand at this point in the cycle, which is what the big boys are doing in the mortgage market. They try and bash the smaller guys around, and it's what Tesla's trying to do in the US as well. It's that type of situation when valuations are getting squashed.
It's an interesting, like you said, point in the cycle as well, and it's perhaps a point in the cycle that we haven't been in for a while either.
Long time. I think a lot of people maybe actually be even going, I haven't been through this cycle before.
This one. If you're born.
You have to have a bit more age on you to get into this cycle where, suddenly the bankers are eyeing up, or which of those companies were we going to start pitching, in terms of companies buying. And I think you saw it the other day. Wesfarmers bought Silk Laser to expand into their pharmaceutical offering. So they're obviously saying, well, that's a company that listed, share prices collapsed, it's a great franchise. I'm, just assuming, and that's why they've lobbed a takeover offer at that one.
Yeah, okay, well, we'll move on, but it's definitely one obviously we're going to pick up again, and well, I'm excited to learn day by day what all of this is about through lived experience rather than just the history books perhaps. But let's go just to some of the areas of the market that have been moving and shaking a bit today. Metals and mining we have to pick up on because it was a little bit more mixed than in previous days. Iron ore is still in focus, just on the basis that it's starting to send some perhaps concerning, I guess that would be fair to phrase it, signals about the economic outlook, sort of still around that $100 mark, which is historically elevated, but down from about $120 not all that long ago.
Yeah, and just speaking to a couple of people this afternoon, they're all just saying that the recovery in Chinese housing construction now is being pushed up to the second half of the year. So both experts really talking about possibly a better outcome in terms of iron ore prices and for Australia into the second half. At the moment, the Chinese economic recovery is they're trying to drive it out of the consumer while these property developers get their house in order.
Yeah, it just seems very aspirational, doesn't it, with that sort of Chinese recovery story where they don't want to sort of dust off the old playbook and rely on industrial activity.
Very different to post GFC, isn't it?
But it's with what is it per capita GDP? They're at what 12,000 a head or whatever
it's
happens
so
to
low.
be. It's not very high. Yeah, it's still less than middle income. So power to them. Good luck, but we'll see how they go. Gold. We'll look at that because actually this was driven just as much, we'll talk about it with our guest today actually, by micro concerns just as well as macro. A Newcrest, disappointing production report today, down 2.4%. Northern Star had a production report as well, and in fact it was higher for much of the session, but obviously has closed flat, it would seem. A little bit more mixed across the other space, but still, I suppose, finding something of a bid because we're talking about rate cuts and financial instability. All those things are still there.
Absolutely.
Definitely. Okay. Got across those. The other one was Kirin Energy today too. Its shares were reasonably volatile. We'll keep an eye on that as we wrap things up, and that'll probably appear on the leaders and laggards list. But nevertheless, we'll leave that there for now. But we did want to get to the stock of the day, and quite naturally, as we were just mentioning before, Blackmores, it was under the microscope of Mark Gardner and Henry Jennings. Here's what they had to say when it came to that stock.
As Hot Chocolate once sang, everyone's a winner, baby, and I think this is the one that everyone is a winner. Kirin have picked this up cheap, given that Blackmores at one stage were above $200 briefly, and also it does seem that Marcus Blackmore is pretty happy to exit stage left, pursued by a bear. Maybe another boat is in the ordering. So I think this is going to keep everybody happy. A lot of the shareholders in Blackmores are actually Blackmores employees and have been around for a long time. It's a pretty good price, as I say. Marcus Blackmore himself has agreed, so that gives them a big sort of 18.8% platform to kick this off. It is pretty much a done deal.
Everyone's happy. I think it's trading at 93.60 odd this morning. I think you'd be pretty happy just to take them off the table. You know, I would probably just sell out today almost. It's trading so close to the price.
I come from a trading background, retail trading CFD, and if you turns, you know, it's sort of 20% gain in your position in a day, you'd sell it and run and put it elsewhere, I think. And I think that was the takeaway from those guys, is that, hey, you've just got a free kick.
Yeah, absolutely.
And, I mean, it probably won't be around for much longer anyway, by the looks of things.
Delisted in August. It looks like they're all ready to go.
Yeah, exactly. And I don't know, have you been a fan of Blackmore's products by any chance?
No.
I've never seen much benefit. It seems to be more of a marketing ploy for things that, yeah, well, I don't know. Whatever floats your boat, I guess. But let's move on. And before we get to our guest, just wanted to talk about the view, and you tackled it again once again today. Perhaps a familiar theme, just talking about the kind of inflation debate versus those disinflationary forces and how they might play out. Would that be a fair characterisation?
Yeah, it was a little bit of this and a little bit of that, and really just emphasising. It looks like First Republic's not going to be around for very long, but as to what it morphs into and what general impact it has on the US banking system, we'll have to wait to see. I mean, obviously the big banks aren't a problem, but there are problems for funding for US banks. Yeah. And that is the real issue. It's not a loan problem. So I really think, having just had a guest on there who's absolutely convinced that inflation is becoming embedded in the system overseas, you're seeing a lot of the unions getting upset and people demanding higher wages. But on the other hand, you read other experts that say inflation is going to be back down at zero next year. And I just wanted to point out that this is not a 2020 scenario where if inflation does go to zero and you do see, you know, interest rates dropping really quickly, there's usually something nasty that's happened along the way to get us to that position. So, you know, the bond markets are indicating recessions, but we also have all the rumblings going on in the US financial system. So my point is we're not going to necessarily relive, drop rates, have QE, fill your boots. You have to still consider, you know, those huge US tech companies. There's a reason why people are buying them. Also, that they have had better than feared earnings, but they are so big and so strong. And if the proverbial hits the fan, people want to be in those great quality stocks with cash flow and pricing power and strong balance sheets and all of that. And that's the same if we slam into a recession. Yeah, okay. It takes a while before you go in and you buy the cyclical companies. So I guess that's what I was just highlighting to people, that, you know, zero inflation is not always the best outcome.
No, we're in a different world, and I feel like that's at least the one thing we can all agree on, is that the fact that we don't know what's going on is because it's just so different to what it was before, or at least in recent history. But let's get to our guest for the episode, and it's great to welcome back to the program Fraser McLeod from Shaw and Partners. Fraser, thanks for joining us. Just wanted, before we get into, I guess, the meat and bones of what we wanted to discuss today, just sort of general characterisation of the market at the moment. Seems to be just a general risk aversion, if I may characterise it as that.
Yeah, perhaps. I think that our market is probably a lot more positive than it was, say, the beginning of the year. When we look at the beginning of the year, there was lots of concern around just inflation running rampant. That's now certainly has diluted down. At the beginning of the year, we were really concerned about just general global economic depression everywhere, and that hasn't really happened, has it? So the consumer has still held up around the world, especially in Australia, and now we have really just the more localized challenges. I think earnings are still a little bit soft, and stocks when they do disappoint to market with some bad news, they get punished pretty hard. But this is not a market that we should be desperately fearful of. I think there is, we're probably trading on, say, about 14.5 times forward earnings, and the earnings are a bit of a decline. So, we're on our eyes, we can still, on outlook, we would still say there's a bit of growth in this market. It's maybe about a 4% yield. We're pretty neutral tactically, which is a kind of boring message to be giving to investors. But there's nothing wrong with giving that boring message, because it's probably the right thing to be. If we were to get a lot more clarity over the key point, which is the direction of interest rates, forward curve on interest rates has been incredibly variable over the course of the last couple of months. And if we were to get a bit more clarity over that, then I think most investors would be happy to push that a little bit further and become fully invested. But at the moment, we've got a pretty neutral stance, not wishing to be overly exposed, but certainly not out of this market.
Makes sense, and perhaps dovetails really well into, I suppose, where we want to dig down into today, which is some of the gold stocks. And you just sort of mentioned, I guess, the outlook just a little bit, one for interest rates, but also the just general caution, I suppose, that seems to exist out there. Nothing too bearish, and we're not in panic stations, but again, cautious is perhaps the word. And I mean, gold stocks gold, I should start with, seems to have maybe benefited from this environment. I mean, would you agree with that?
Yeah, absolutely. So we've been real bulls on gold over the course of the last year. 6 months ago, that didn't look like an amazing call, and now it looks pretty good. So we've got a very different market from 6 months ago, however. So the real scares around some of these smaller local banks in the US has probably contributed to gold really catching quite a bid. But we actually look at the price on gold and just look at the price alone. Whilst the price is just hovering around 2,000 US dollars an ounce, the Aussie dollar gold price is trading at 3,000 Aussie dollars an ounce, or just slightly above, and that is the highest Aussie dollar gold price ever. So if you're an Aussie gold miner, you're making some great cash at the moment. Even if your costs are going up, and even if your volumes are under a little bit of under a little bit of pressure as well. So there's lots of action also because of Newcrest and the bid from Newmont on Newcrest to buy them back, and it'll probably go through. That will leave investors here in Australia with a question mark as to what to do with their Newcrest money and where to place it next as well. So yeah, lots of action. There is central banks around the world have been buying lots of gold, and so it is that natural hedge within portfolios. If truly politically, or if war, or if there is still lots of sticky inflation around, then your portfolio is going to be helped out by holding some gold exposure, and you can do that in a variety of different ways depending on your appetite towards risk.
Do you basically, would you prefer to hold gold in the ETF form rather than stocks, because you bring forth all the production risk, cost risk, etc., hedging, etc.?
Yep. That's a really good question, and a question that we get asked a lot from clients as well. So it's quite easy to gain exposure to an exchange traded commodity fund and hold the actual yellow metal itself, and have no production risk there. It's purely just a play on commodities. Whether you think of gold as a currency or not, so yes, you can hold the security of gold and have that without the gold production worries or the equity market ownership worries. That's entirely possible, and we do that for clients. I do that for clients. It does give quite a lot of stability, and the gold price in Aussie dollar terms for Australian investors has done really quite well over the course of the last few years. Has almost, here's an amazing statistic, over the course of the last 10 years, has almost kept up with the ASX total return, or ASX 200 total shareholder return, which is an amazing statistic, and it tends to complement because it works as a natural hedge. You'll tend to find that the gold price won't move in the same direction at the same time as your equities portfolio proportion of your overall portfolio. However, in order to get greater returns, if you are wishing and do have a positive view on the gold price, then the more leveraged way to do that is to play the gold equity miners, of which you can play larger cap stocks. There's not too many larger cap stocks left. If Newcrest were to exit, there's really only going to be Northern Star and Evolution, and then a spattering of much smaller companies, and then some real specky explorers after that. So it's pretty limited in terms of the exposure that ASX investors can get entry to. So I'm sure a lot of the Newcrest money, if it does work out that they are taking over, will be needing to find a new home there.
So let's talk about, I guess, possible preferences in the space if you had to obviously put your money into a gold miner at the moment. Is it sort of sticking to those blue chip names, Evolution, Northern Star? Is that the picks potentially?
Yeah, so obviously Northern Star was out with their figures today. Northern Star is the largest player in our market after Newcrest, so we would expect, again, a lot of if Newcrest were to get taken over, a lot of investors won't want to be holding the Newmont shares, and they'll probably divert quite a lot of their cash towards holding Northern Star. Now, Northern Star is quite hedged, which works well if the gold price goes nowhere or goes down, but doesn't work so well in a very strong bull market. They've got a very, very large resource, and so their upside isn't as great if they had been unhedged. But it will probably attract the biggest lift because it's the biggest name that's left on our market if Newcrest were to go. Then you've got Evolution. Evolution is still a large company, quite a bit smaller than Northern Star, but they're still worth about $5.5 billion. Less hedged. They've got 4 mines in Australia, and also will probably attract quite a lot of money if we were to see Newcrest getting taken over. After that, however, you're down to an awful lot of smaller names and a little bit more risk and a little bit more reward potentially as well.
All right, sage words, really great insights. And Fraser, great to have you back on board for another day. So hopefully we'll do it again soon. Fraser McLeod from Partners, have a great afternoon.
Good, thank you. Good afternoon.
Cheers.
Okay, well, bit of insight on this gold space there. Again,
absolutely.
It's right on the top of a lot of investors' watch lists right now, especially the run-up that we have seen in prices. But I thought we'd jump to what we've got coming up overnight, because we've actually got an interesting mix of macro and micro, because advanced US GDP, so that's the print that people should actually care about, because that's the first one of the three. We get the prelim and then the final, but advanced is the one that really sets the tone. Unemployment claims are trending higher recently.
Yeah, that's a leading indicator of what's happening. So I would say that's probably one of the more important ones, really. Yeah. And as you say, they have been trending up, haven't they? Yeah,
it's that kind of slow trickle that starts before the flood, potentially.
Apparently so, given that the unemployment data is always the lagging indicator. But I think those Caterpillar and Amazon earnings that are coming out will be really interesting. I mean, obviously, Amazon will be leaning on AWS to see whether or not we've still got that growth in their cloud computing division, particularly after the strong results that we saw out of Microsoft's Azure and Google's cloud business. And Caterpillar, of course, in terms of infrastructure, mining, see how that's tracking. I haven't looked at the share price lately, but it was one of the favourites along with Deere in the US.
Yeah, it will be really fascinating. In fact, I'm probably looking forward more to that Caterpillar result, although Amazon's going to influence the market actually much more just by virtue of its size. But I mean, it's going to combine that US story along with that China story because of just the industrial sensitivity. So that's going to be quite interesting, and it's been sort of trading flat over the last 6 months. Actually, it's held up reasonably well. So that's going to be really fascinating to watch. Maybe we'll skip ahead just to what's on tomorrow as well. And really the only thing that I could think of that I could see on the calendar that jumped out was the Bank of Japan decision, which is probably going to be a bit of a nothing burger from what I understand. But the new governor there, second meeting in Ueda, and hang on, I'll just make sure I start to through repetition, get his first name, because I've just been calling him Ueda, Katsuo Ueda. He's more or less expected to be sort of the continuity, or was the continuity candidate So nothing necessarily expected to change from their policy, but it always comes with that speculation on will they change yield curve control programs? What will they say about inflation being a bit above target, which it was actually, the CPI release recently, which is very un-Japanese.
Very un-Japanese, but it's, you know, in the whole scheme of things, it's still, they probably enjoy having some inflation. They've been fighting to get it, you know, up a little bit for years now, haven't they? So, yeah. But as you say, a bit of a, what was it, a nothing sandwich?
Nothing burger.
Nothing burger.
Nothing sandwich is a more healthy version. Or maybe nothing California roll, we'll call it, in the spirit of Japan. Nothing sushi.
And obviously, a lot of that's probably discounted in the markets. And should they do something, then obviously it could create some volatility and maybe the currencies and things.
Which again would be very un-Japanese of them as well. So we'll keep an eye on it, because for the wonks it could be interesting, but maybe not a source of volatility. It's maybe unlikely. But anyway, time will tell on that one. All right, leaders and laggards. Let's see who is the top of the pops today. And well, I think the first one's going to be obvious.
Blackmores.
There you go, $93 a share, if you don't mind. So it's a 22.3% increase. Brainship continues to be volatile. You had a point on Blackmores?
No, I was just going to say there's a rumour going around about Rio buying Allcom.
Yeah, no, I saw that today.
Yeah.
Interesting, and I think that's what drove the price higher.
Speaking about M&A.
Yeah. Yeah, well, this is the really funny how these sort of narratives change, right? You know, and how short-sighted we can be. I remember asking questions of people maybe 12, 18 months ago, would some of the big miners make it into the lithium space? No, it's too small, not of interest to them.
And then suddenly they're all going, oh, I think we need a slice of this.
Yeah, we need to take a bite.
BHP as well.
Yeah. So there you go. Again, that was a rumour, but you know, there's every reason to think it's true, and I do believe that's why we're up 5% today. Couldn't find any reason for calcium though, unfortunately. So that
that's the old sea link, isn't it?
Yeah.
Maybe people are taking more tours across to Tasmania on that boat, which is meant to be really good.
Is that the Spirit?
I think so, yeah.
Oh, really?
Yeah.
Okay.
Stand to be corrected, but I think so. And Nanosonics, I think that's been a couple of days, but we haven't found anything there either.
No, Polynovo is the same as well. It just seems to be this sort of inexplicable desire for relatively speculative health tech stocks, which, I mean, power to them. Nanosonics is apparently a great company with a great product. A nurse told me once or twice during a hyperventilating sort of visit to the emergency room once. So personal aside, never mind. So keep that with my therapist. But let's go to the laggards now, however, see what is at the bottom. And Sierra Resources, and that was one that the only story I could find on that was it reported the costs associated with expanding a facility in Louisiana in the United States. That's all I could find, but it's a 10% drop, so I believe that could be related to that, I think, unless I, well, hopefully stand corrected, because it will, you know, solve that particular issue.
It looks like they've got a quarterly production out, so that obviously disappointed. We've had quite a few disappointments in terms of quarterly production, which I discussed with Daniel Ortizi. Today.
Well, go watch that back on your platform, folks, because he's always great on the resources space.
Absolutely.
Core Lithium as well, downgraded by Goldman Sachs. So you always wonder, because they just seem perpetually bearish on lithium. This whole, you know, not a big believer in that kind of supply deficit story, at least in the short term. So there's that one. You're looking at Megaport at the moment. United Malt Group, just in the meantime, came out with a bit of an update today too, and said they saw a 6 to 8% drop in volumes, and on weaker beer demand. So
yes, that's right, absolutely. Who'd have thunk it? Weaker beer demand, because normally if you go into economic slowdowns, guess what happens? Yeah. People drink more beer.
Well, this is what I was saying.
They don't drink wine, they drink beer.
No, I bet. No, certainly you have to start reaching sort of lower down the shelf. But no, I mean, I stopped drinking about 12 months ago, so I think that accounts possibly for the 6 to 8% drop in volumes. Based on my own personal background. Anything on Megaport?
Yeah, they just had an update yesterday, an investor briefing. So that came out at about 140 yesterday, but maybe there's ongoing selling coming through today.
Yeah, okay. Well, let's get to the small caps, and drum roll please, because this is my favourite time of the day where we get au revoir. There we go.
Just for you.
Just for me. I still have to buy some of that, and I know when it does, it'll go down to a cent or something like that. But nevertheless, Jovois is in there. Symbio, top of the pops there. Retail food Interesting.
Yeah,
that mustn't be Retail Food Group, obviously. That's got to be something different.
And Kogan continuing its run on from yesterday, up another 12.4%.
Yeah, share buyback news there.
Yeah. And I think, wasn't there a trading update as well?
There was a trading update, yeah. It was. I'm not too sure compared to prior numbers how it was, because they still posted a loss. But that buyback was a pretty big deal. And I don't know, maybe that's simply just going through the market. They're actually executing that now. So maybe a reason for the price going higher. I'm not too sure, but see if we've got the small cap laggards for the day. We won't labour the point here, perhaps, but
there we go.
There we are. Tigers Realm Coal. It seems to be there perpetually, but again, it's 1 cent per share. That's going to happen. Let's move on. All right. There we go. Get the graphic down. There we are. All done. I think that takes us to another end of a day, and maybe we'll just. I think you've got it on your screen there. Just where the ASX 200 finally
Absolutely.
closed.
So I have it down 23.6 points, 0.32%. That's 7292.70 on the index. So again, if we're going to compare ourselves not so much to NASDAQ or the S&P, but the Dow, it's a pretty good performance, I think, compared to what happened last night. So the Aussie market really holding up relatively well at the moment. Maybe under the surface there's more profit taking going on, but I think the US markets have really been subjected to a lot more profit taking than we have at this stage. Yeah,
it would certainly seem to be the case, and well, who knows what tonight will bring, because as we said before, there's a lot of data, but we will bring it to you all, to you, I should say, tomorrow morning when we're back on air. But in the meantime, remember you can catch up on all the latest news and views and interviews on our website and app. Have a great night. We will see you tomorrow morning.
Bye.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.